In 2007, Jeff Bezos, already one of the richest men on the planet, paid exactly $0 in federal income tax. He did it again in 2011. Elon Musk pulled off the same thing in 2018. None of them broke a single law. They were all running the same quiet playbook, a strategy so simple that Wall Street lawyers summarize it in just 3 words. Between 2014 and 2018, the 25 richest Americans grew their combined wealth by $401 billion. The federal income tax they paid on that gain worked out to just 3.4%. A typical American household in the same period paid around 14% of their income. By the end of this video, you'll understand exactly how that gap is possible and why it's all perfectly legal. Step 1. Buy. Billionaires don't get rich from paychecks. Elon Musk's official salary at Tesla, $0. Mark Zuckerberg's at Meta, $1 a year. Steve Jobs took the same $1 at Apple. Their wealth doesn't come from income at all. It comes from owning things, mostly stock in the companies they built. And that distinction between earning and owning is where the entire game begins. Here's the magic trick at the heart of the system. The IRS doesn't tax wealth, it taxes income. And when your stock rises in value, that gain is called an unrealized gain, and an unrealized gain is not income. On paper, you can get $10 billion richer this year and legally owe the IRS nothing at all, as long as you never sell a single share. Look at the difference. Sell your shares and the profit becomes realized, taxed at up to 23.8% at the top federal rate. Hold them and the exact same profit stays unrealized, taxed at exactly 0%. Same stock, same gain. The only difference is a signature on a sell order. So the first rule of billionaire wealth is brutally simple: never sell. And the gap this creates is staggering. Between 2006 and 2018, Jeff Bezos grew his fortune by roughly $127 billion. The income he reported to the IRS over those same years, about $6.5 billion, barely 5% of it. The other 95% of his wealth creation was invisible to the tax system. Not hidden, not offshore, just legally not income. Once you understand that one idea, everything the rich do with money starts making sense. But hold on. If billionaires never sell their stock, where does the money for the yachts, the jets, and the private islands come from? That's step 2. Borrow. It works like this. The billionaire walks into a bank and pledges a slice of their stock as collateral. The bank opens a line of credit against it, often at low single-digit interest rates. And here's the part that changes everything. Borrowed money is not income either. It's a loan. So the cash hits their account completely tax-free, while the stock keeps growing untouched in the background. And this isn't some obscure trick. Larry Ellison pledged billions of dollars of Oracle stock to secure a personal credit line of nearly $10 billion. Elon Musk has pledged tens of millions of Tesla shares the same way. In 2021, Americans held well over $100 billion in these securities-backed loans at major banks, and for the ultra-rich, it's simply the cheapest money on earth. Now think about the math, because this is where it clicks. Selling stock could cost you up to 23.8% in tax immediately. Borrowing against it might cost 3 to 5% interest per year. Meanwhile, the market has historically returned somewhere around 10% annually. When your assets grow faster than your debt, borrowing isn't reckless. It's mathematically smarter than selling, and the tax bill never comes. And notice who else wins here: the banks. Securities-backed loans are among the safest lending they do. The collateral is liquid stock they can seize and sell in seconds if the market turns. That's why they offer their wealthiest clients rates ordinary borrowers never see. Morgan Stanley, Bank of America, and UBS together hold hundreds of billions in these loans. The billionaire avoids taxes. The bank collects interest. Everyone at the table wins except the Treasury. Which brings us to the grand finale. What happens when a billionaire dies still holding all that stock and all those loans? This is where the strategy earns its name. Step 3. Die. Under a rule called the stepped-up basis, when you die, your heirs inherit your stock at its current market price, not the price you originally paid. The cost basis literally steps up to today's value. Every unrealized gain you accumulated across your entire lifetime is wiped off the books in an instant. The income tax that was deferred for decades isn't just delayed anymore. It simply never existed. Run the numbers on a simple example. Say a founder buys stock for $1 million, and over 30 years it grows to $1 billion. If they sell while alive, the federal tax bill on that gain could run around $238 million. If they die holding it, the heir's income tax bill on that same gain is zero. The estate pays off the outstanding loans, and a fortune that was never taxed as income slides quietly into the next generation. And this is not a rounding error in the system. Economists estimate that in America's largest estates, those worth over $100 million, more than half of all the wealth consists of unrealized gains that have never been taxed as income. Thanks to the step up, most of it never will be. Now put a regular paycheck next to this system, and the contrast gets uncomfortable. A nurse earning $75,000 a year has taxes withheld from every single paycheck before the money even lands in her account. Federal income tax, Social Security, Medicare, all taken automatically, all unavoidable. Her wealth is taxed the moment it's created. A billionaire's wealth is taxed whenever they decide it is, which, with the right planning, is never. And the cost of all this isn't abstract. Congress's own analysts estimate that the stepped-up basis alone drains roughly $40 billion a year from the Treasury. Money that has to be made up somewhere, usually by people who get their taxes withheld from a paycheck. Over a decade, that's nearly $500 billion quietly stepping around the income tax system. The receipts are public now. In 2021, ProPublica obtained years of confidential IRS files on the wealthiest Americans. Warren Buffett's true tax rate, taxes paid compared to wealth gained, came out to 0.1%. Jeff Bezos about 1%. Elon Musk around 3%. Nobody was charged with anything because nothing illegal happened. That's the point. The playbook is written directly into the tax code. You might be wondering, why does a rule like this even exist? The stepped-up basis goes all the way back to the Revenue Act of 1921. Back then, tracking what a dead person originally paid for assets decades earlier was genuinely impractical. Records burned, brokers closed, memories died with the owner. It was a paperwork fix. A century later, computers track every trade in real time. But the rule survives, defended by some of the most effective. Lobbying money can buy. Could the rules change? There have been proposals, a billionaire minimum tax, taxing unrealized gains above $100 million, closing the step-up at death. So far, none of them have survived Congress, and most European countries that tried broad wealth taxes eventually repealed them because capital simply moved. For now, buy, borrow, die remains completely legal and fully open if you're rich enough to use it. You may never borrow against $1 billion in stock, but the principles scale down further than you'd think. Own assets that appreciate, because owners are taxed better than earners. Avoid interrupting compound growth with unnecessary selling. Understand that long-term capital gains are taxed far more gently than wages. And remember that the tax code isn't neutral. It quietly rewards people who hold assets and quietly punishes people who only earn paychecks. The wealthy aren't playing a different game by cheating. They're playing the same game, they've just read the rule book. If this opened your eyes, subscribe, because next week we're breaking down how banks legally create money out of thin air every time they issue a loan. The more you understand the machine, the better you can play it. See you in the next one.